Global interest rates are on the move. In fact, they are on the move in the world's top three economies. Will the markets care, though? That's what we're going to ask ourselves today. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we're going to look at the big inflection points up ahead this week. We face what would be a very active week by any other measure. But of course, we are here in the second week of December where liquidity is already on the wane as the holidays approach and participation is relatively modest. Witness, if you will, the relatively muted responses to an attempted coup in South Korea, the toppling of the government in Syria, and the unraveling of the administration in France. The markets seem relatively blasé about the whole lot. But this week, it is the cost of money, the most fundamental of all trading and investment considerations, that is going to be on the menu for consideration. And so it is here where we might get a bit of a crescendo on what has been a very action-packed year up to this point. And we'll start the conversation with a look at what the markets did last week, and then consider what those key points are. As we can see here, kind of a quiet week last week, but for the NASDAQ. The S&P manages an overall rise for U.S. equities of 0.8%. A little bit of a wiggle lower on bond yields as the correction continues for a third consecutive week. We, of course, will touch on what all of this follows from, but needless to say, if you've been watching markets since September, you know that there's been a massive repricing for reflation after the Fed's dovish outing at that time, and that's seen a powerful rally in the dollar, a powerful increase in yields. And over the past 3 weeks, all of that has been redistributing a little bit as that story seemed to run out of speculative fodder. Yields managed to continue down that way, albeit modestly. 10-year down 0.6%, the 2-year down a little bit more, 1.4%. Crude oil and gold basically do nothing. They wiggle within familiar ranges, but the moves ultimately don't take us very far at all. In fact, as we get news over the weekend here now that the Bashar al-Assad regime in Syria has fallen apart and the country is being taken over by rival forces, we get a little bit of a pop in crude, we get a little bit of a pop in gold, which take us to the tops of the ranges that we visited the lower boundaries of last week. So we have a little bit of back and forth, but none of this seems to be a trend-defining sort of thing either way. The dollar basically standstill last week. Euro down 0.2%, the yen down 0.3% after sizable gains the prior week. So not much doing there last week. And we'll look at the dollar against the Australian counterpart shortly as we discuss China. And Bitcoin up 4.1%, relatively modest uptick in Bitcoin terms. But no big story there, it would seem, other than the selection by the incoming Trump administration of a crypto favorable sort of nominee to lead the SEC. So we have here a relatively modest week for price action last week, but all the reason to expect that maybe that sort of low gets shaken loose this week as we start getting some big U.S. economic data. Now, last week was not starved for it either. To be frank, we had a speech from Fed Chair Jerome Powell. We had, of course, the U.S. jobs report. So there were opportunities for things to make moves. They just opted not to have immediate follow through. And that'll be what we try to divine for this week. Can we actually get these markets to go in a direction? And we start with US inflation data. The expectations here that we're going to get an uptick on the headline number to 2.7%. That would be a significant leg higher, of course, for US inflation. That would be the highest reading, in fact, since July's 2.9%, and the second consecutive month of increase on the headline number. The core reading expected to remain unchanged, 3.3% year on year. And this is the bit that the Fed is, of course, watching most closely. We are looking here mainly at inflation that lives within the service sector. You can clearly see here, looking at the latest contribution numbers, housing is sort of subsumed within that part of housing services in the core services bit. That's, of course, still a bit sticky, but food is steady, and goods as well as energy are at this point deflationary forces. They have a negative contribution to headline inflation still. And the real sort of area where there is stuff to do for the central bank is in that core services section. So it is that core CPI number, the one excluding energy, the one excluding food, that's the most critical. And if we were to come in at 3.3%, that would essentially mark the fifth consecutive month without disinflation. We started with a downtick from 3.3 to 3.2 from June into July, but since July, core inflation has not gone down. And that's really something of a problem for the Federal Reserve, one would think, if not for the recent comments that we've received from Fed Chair Powell last week. Again, Fed Chair Powell in a prior speech, and of course the November policy announcement where he discussed the moving parts after the November FOMC meeting. And all of that seems to point, along with minutes from that November meeting that were recently released, in the direction that policymakers are not prepared to jump on this piece of data or that. They continue to see, despite these recent months of standstill, the trajectory for inflation as heading in the direction of the 2% medium-term objective. They have repeatedly, whether it's Powell or other policymakers or the FOMC minutes, argued for a look through near-term data volatility, especially of the likes that last week's jobs report gave us. And so it doesn't seem like we are looking at the kind of inflation data that's going to change, at the very least, December's Fed policy trajectory. And moreover, we look at the way that U.S. economic data has performed relative to forecast. We've been talking about this bit for about a week and a half now, this idea that the City Economic Surprise Index has moved through its 20-day moving average after a long string of outperformance from late August, and that this is eye-catching. Not because we're trying to do technical analysis on a macro indicator, that would be ludicrous, but because we're looking at an index that measures data outcomes, not in absolute terms, but with reference to forecasts that come out of economic models that typically look at data on monthly release cycles. Some of it is quarterly, like GDP results. Some of it is weekly, like jobless claims numbers. But the overwhelming majority of key U.S. economic data is on a monthly cycle. A 20-day moving average is about a month, or about a month of trading days. So 5 days a week, 4 weeks, give or take. So one would think that after about a month of data going the wrong direction relative to forecasts, the economists running these models that generate the forecast against which we're measuring here would start to turn the knobs and adjust their models, because they would say, well, reality is not endorsing our model. That means our model is wrong. We need to fine tune it. And so when you go through the monthly average for this index, the sense you get is that perhaps the fine tuning has commenced. That there's been enough of a judgment reached that the model is wrong, or models in aggregate, and that now they need to be trued up to what the economy is actually putting up. Which in this case suggests that just like here, or here, or here, or here, you might get, after the move through the 20-day moving average here, continued correction toward basically the zero line, where data is going to be relatively in line with expectations, or at least closer in line with expectations as we go. And that probably speaks to CPI numbers that should be less than controversial. The first upshot there is that the December rate cut is probably firmly on the books. 86 almost percent a chance of the cut being baked into Fed funds futures, and it seems unlikely that you get too far off this square. Maybe you get a little bit lower in the direction of the high 60s, the 70s, if the number is a little bit warmer than expected. But it doesn't look like the Fed is going to get shaken out of this move. Moreover, if the numbers are close enough to forecasts that the view for next year is sustained. As we can see here, for 2025, we're looking at about 67 basis points in easing. It's been oscillating around 60-odd basis points for a while here, as we can see. And that is basically comporting with 2 cuts being baked in and some speculation about the probability of a third, but not particular conviction. We'd have to get in the direction of 70 and change, and obviously 75 would be a full 3 cuts. So we're sort of on the fence about that third cut here, but 2 of them are in the outlook, and we can see that that has marked a very significant dilution from what was there when the markets started to think about the beginning of the Fed rate cut cycle in earnest before the initial move in September. We can see here the total was 233 basis points for this year and next, of which 100 basis points, right here, was this year. Now, of course, we know at this point that 75 basis points of that has already been delivered. 50 basis points in September, 25 in November, likely another 25 in December. So it's next year's outlook that's the moving target. If it was 100 about basis points for this year in September, when the markets reached their sort of dovish crescendo speculatively, then it was about 130, 133 basis points for next year. And now at 60 and change, it's been cut in half. That's in part, of course, because U.S. economic data has been doing better relative to expectations, suggesting the economy is anything but cool. And the response has been, since September, a rise in inflation expectations. These are 5 and 10-year break-even rates from the bond market that give you the priced in expected inflation that the bond market is telling us is there. That rise in inflation expectations gave us higher yields. Here we have both the 2 and the 10-year going up, so the curve is shifting up at the front and the long end. And of course, the dollar has rallied. But what we've seen since mid-November is some of these moves have started to correct because the markets have basically settled on expectations. If we take a look at what's happened here, again, since mid-November, there's been a peak in the sort of move to reprice this and a bit of a correction. Against the backdrop of that, this redistribution of speculative positioning. Not that the narrative has changed, but just whatever speculative capital was looking for just this as a trade seems to have had enough of what it needed to see to start taking money off the table by the second half of November and obviously going into December. If the CPI numbers are relatively in line with forecasts, then this might continue. This might get the green light for its next leg, which might mean lower yields, might mean a weaker dollar in the wake of these numbers, as long as they're not shocking. Then the interest rate story continues, but from the other major non-China driver of global growth, and as we've said here quite a lot, the Eurozone, the US, and China together comprise 58% of global GDP, conservatively speaking, because a lot of the other economies in the remaining 42% are vendors to these big three and need these big three to have growth in order for them to have export demand and growth in turn. Before we get to China, though, it's the Eurozone. Here we have a monetary policy announcement from the European Central Bank this week. Expectations are firm that there's going to be another rate cut of 25 basis points. We can see it is almost all the way baked in, about a 70-odd% chance that this move is going to occur. And as a matter of fact, if we look beyond this year into next year, the curve, the futures curve here, would imply that actually the perspective on the ECB going forward has become more dovish relative to when the central bank met in mid-October and in mid-September. So mid-September we can see is the more hawkish of the three curves here, and then over time we have a rate cut from 3.5 to 3.25 in October. That's that shift right here. But we can see the tail end of this curve is a little bit steeper than the tail end of the current curve from January onward. So the markets are expecting a little bit more dovishness from the ECB. And in fact, we can see that correction here. This is that October up through now expansion of dovish speculation. And as we can see, it's not coming from expectations for this year. That's pretty well locked in. It's coming from a more dovish outlook on next year, where we're now expecting about 110 basis points in rate cuts. So leaning on 4 cuts with some optionality for a 5th. Not much, but a little less than half of it is there. It would need to be 125 to be the full 5. So we can see why this is, of course. Eurozone economy, looking at the way this PMI data is coming apart, it had a little bit of a rebound into positive growth territory, as ever. PMI numbers have positive growth above 50, which is the neutral kind of boom-bust level here. Below 50 is contraction, above 50 is growth. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. We can see that, of course, manufacturing has been in contraction going back to 2022, but the overall economy here has been following the service sector. That's the orange line. The catch-all is the composite in the kind of grayish, bluish line there. And what we find is that at the end of last year, there was recession-like conditions in the Eurozone, well under 50. We had a little bit of a pop in the first half of this year, little bit of a attempt at recovery, and of course since then things have unraveled again. We are now back below 50 across the board, and the most recent composite numbers are of course eye-wateringly weak as services contracts again. So it makes sense really why along the same period of time here the outlook has become more dovish. It does look like the economy needs more stimulus. However, looking at the latest numbers from the Republic of Germany's finance agency here on break-even rates, again, this is a measure of inflation expectations baked into the bond market, we can see since bottoming in October, there's been a little bit of a wiggle higher in short-term inflation expectations in Germany. This is kind of a benchmark, a sort of bellwether for inflation expectations regionally, and that you've had this rebound may give the ECB some cause for pause. They may not want to jump out the window and be even more dovish than is already expected because inflation expectations are ticking the wrong way. Now, maybe this is just a correction. Maybe this is a temporary development ahead of the winter as preparations get made for another winter with energy supplies, at the very least, disrupted by the Russia-Ukraine conflict that continues. And there is perhaps some risk premium built into these inflation expectations around what could happen if it were a cold winter this time, which it hasn't been over the past 2 years. And of course, the energy supplies in Europe at this point look well stocked, but markets do speculate. So it's unclear why this is popping necessarily, but popping it is. And if we consider then the ECB's position with a shrinking economy but rising inflation expectations, they already have a bunch of dovish intent on the books. They may not want to dial it up quite right here. And with that in mind, you might see a relatively status quo ECB that doesn't move the needle too much this way or that. You get the cut, you get the dovish rhetoric that cements you for easing next year, but maybe you don't get anything that's even more dovish beyond that in this kind of inflation expectations upswell that we're seeing here, modest though it is. And that may give a push higher to the euro, if only as relief that the ECB, faced with the economy hitting the skids again, isn't prepared to flood the zone with more money than it's already committed, at least looking at expectations. And finally, there is China, the world's second largest economy and the third in the world's top 3 economies. Here, we're expected to get a trade report where there is expected to be continued strength on the export side, not quite as strong as the surge of over 12% in October, but November's number is still relatively buoyant here at 8.5% year on year. Imports anemic, just 0.3% expected after a contraction in the prior month. Some of the strength in exports, of course, has been chalked up to front-running ahead of any would-be tariff increase from the U.S. with the outcome of the U.S. presidential election and the return of Donald Trump. So it doesn't look like this is necessarily a sign of strength, more like a sign that there is an attempt at de-risking, essentially, before this is going to become a larger issue, because, of course, it is U.S. importers that pay tariffs, and the latest from Chinese PMI numbers have suggested that there's been an increase in export orders and in export demand from the U.S., and indeed those very same numbers and those very same surveys suggest what's happening here is that demand is trying to stock up inventories before costs go up, because tariffs are, of course, a kind of consumption tax on imports. So this is probably going to continue to be an uplift on exports for a little bit longer, but it doesn't so much speak to the strength of the overall economy, which remains in shambles. China has had economy-wide deflation for 6 consecutive quarters now, and the inflation numbers that we got published over the weekend here didn't tell any better of a story. Consumer price index numbers still show essentially the absence of domestic demand, 0.2% versus 0.5% expected. The situation on the wholesale side is a little bit better, slightly slower decline than anticipated, but nevertheless, they've been in negative territory going all the way back to mid-2022. What's more interesting in China is that there was a meeting of the steering Politburo committee, that's the 24 top Chinese officials, including President Xi Jinping, over the weekend, and they once again started to put some feelers out there and to stoke some hopes out there that maybe they're finally ready to provide some fiscal stimulus that works. Monetary stimulus has abjectly failed for about 2.5 years now, because we clearly see that flooding the market with money has not created demand. As a matter of fact, new loans as a share of GDP have been falling at an increasing rate, not the other way around. We should be seeing loan growth buoyed by aggressive monetary easing, such as it has already occurred and such as is being promised now for next year, but it plainly hasn't worked. And the People's Bank of China, the central bank, has done surveys showing that if presented with new capital, overwhelmingly most consumers would prefer to save that money because they don't have confidence in the direction of the economy. Very few would either invest or spend. Close to 70% would save. Moreover, bank deposits are at record highs, highlighting that that's exactly what's occurring. So what's needed and what everybody's been pining for is the government basically creating the kind of demand replacement that we saw during COVID in the US and the West, where the government spends a bunch of money to get the economy kick-started. China has been resistant. The Politburo over the past day or two here said they're prepared to be more aggressive and more accommodative on the fiscal side. We can see the response here. The Aussie dollar, a proxy for Chinese economic momentum, it popped here, though it didn't overtake its down move on the whole. If we get a set of trade numbers later this week, which, like recent Chinese economic data, which has carefully edged up relative to forecasts above zero, such that it's cautiously tending toward outperformance, CPI numbers notwithstanding, if that gives us reasonably okay trade numbers, then perhaps Beijing's officialdom is going to get the benefit of the doubt on these fiscal stimulus pronouncements, at least until a few weeks or months pass and it is clear, if it is clear, that they don't mean it yet again, because we saw this movie in September and nothing came of it. Perhaps something will now, but as long as the data is not awful, maybe the markets are prepared to believe that this time is different. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what might follow. I'm on for Futures Power Hour with Chris for Mondays and Fridays, on with Victor Jones for The Price of Truth on Wednesdays, back with Victor and Tom for First Call on Sundays at the Global Market Open, writing for the News and Insights portion of tastylive.com, and commenting sporadically on the platform formerly known as Twitter, as well as on Blue Sky at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow.